Hello again, everybody. Thank you for your patience and thank you for staying with us. We've had technology lets you down when you need it most. We never had this kind of difficulty before, but there's always a first time. Today we'll be talking about the state of asset classes in 2019, and that we feel that's a subject of interest to everybody, and we hope we can deliver to you what you're looking for. Yeah, please bear with us. We're almost there. Thanks. Okay, that formula in front of you is very well known. Higher yield and higher debt equals higher risk. And let's see what we mean by that based on the experience that we've been having in the last few years. We had a long period of time of low interest rates that resulted obviously in low yields. When you have low yields in a rising interest rate environment, that means you have a higher risk. For example, if your bond is yielding at 3% and the rates go up to 5%, obviously you're going to have some problems maintaining the value of that investment. And when you combine the higher yield that's happening right now with the increase in interest rates, with the deleveraged balance sheet, the corporations went on a financing binge for a long period of time. In other words, when we had a deleveraging of the balance sheet after the crisis of 2008, companies went out borrowing big time. You combine that with the rising interest rates today, that results in credit quality erosion, meaning companies will have a hard time maintaining the payments, or at least difficulty maintaining the payments. Yields obviously have trended higher, making it even more difficult for corporations to refinance the debt that they accumulated during that the financing binge when interest rates were low. And a lot of these loans are not 30-year loans; they're 5-year loans or so. And when time comes to refinance at a higher interest rate, the companies are having problems accomplishing that objective. I'm frozen again. Please bear with us. We're having the program is freezing on us again, so trying to move the slide and it's not moving, so we're working on it here. I'm hitting it very hard. Look at this graph in front of you. It looks like a nice painting, but really what I wanted to see is the colors. The blue sliver at the very top is your basically AAA rated bonds. Then you have your AA, and you have your A, and you have the BAA. Over the last few years, we're seeing a tremendous growth in the lower quality bonds, and what's happening right now is exactly that. That is a prescription for possible defaults down the road a piece. Very little is in high grade bonds. When you consider that environment, you have to look at what are we supposed to do at this point in time in the fixed income area. First, we consider shorter duration bonds. If any of you are following what we're doing with the Investors Advantage, we're kind of sticking to a 5 years or less type of situation. What you do when you get that kind of duration, you have what's called an attractive risk-reward equation, whereby you can capture 85% of the yield and with only 36% of the the risk that's involved with that. So 1 to 5 is where you want to be in the fixed income scenario. What you have in front of you, if you look at the 1 to 5 by comparison to the aggregate average on the bond side, you see that the 1 to 5 is doing a much better job for the investors based on the yield for the duration. But then again, why stop here? The U.S. stocks in the first 2 months of this year point towards further advances, believe it or not. We have seen what happened late last year, and we see what's happening with the exception, maybe what's happening today. I know in the morning the futures were down. I didn't look after that, but we're not going to obviously measure it day by day basis. But we look at what the S&P 500 performance through year end after rising January and February months. With the exception of 2011, every single year from 1991 till 2017, whenever February and January are good months, the year ends up in the positive. And our prediction is, a little bit similar to what we did last year when we predicted low mid-single digit returns on the S&P 500. Of course, when we predicted the mid-single digit returns, we did not think it's going to be negative single digit returns. But hopefully this year the trend is going to be better, and we'll have a 5 to 7% S&P 500 return. The comeback of the S&P 500, is it complete? When you look at what happened in the S&P 500 from 2015 to now, basically 2019, you have that square on the upper right-hand side showing the reversal from the negatives of late last year to a positive the beginning of this year. We're showing a cumulative advance in the S&P 500 and in the New York Stock Exchange that shows that we are probably done with that almost 20% correction late last year into early this year. We're getting back into a positive territory. Now, that being said, it doesn't mean volatility is over. I think volatility is going to increase a little bit more, and that's based on a few factors, not the least of which is the fact that our trade deficit, ironically, after the promise of a better trade deficit based on the tariffs, it seems like our trade deficit grew in the last month at an alarming rate, which means the protective barriers we're trying to put into the trade are not only not working, they're working against us. So we have to be careful with that. In addition to that, on the stock side, we're looking at probably a little bit more of a move towards the mid cap, maybe slightly the small cap. But if you look at the changes that have been happening in the last few weeks, they're working in favor of the mid cap. So you'll see some more allocation, or we recommend also some more allocation into some of the mid cap company, particularly in the areas of medical, drugs, and the technology, where the mergers and acquisitions, in our opinion, will continue to fuel that part of the market. The buybacks is another reason why the stock market will continue to do a little bit better in the next few months. If you notice what had happened back when towards the end of January, when Schumer and Sanders called for restrictions on the buybacks, and I can see where they're coming from. They're coming from the fact that a lot of the repatriation of the funds from outside the U.S., as well as the tax benefit that corporate America, a lot of it went on. We see a little bit more later in this presentation what that means. So much of that money went into buybacks, and they were trying to slow that part down in order to create possibility for these companies to invest instead of buying back shares. Obviously, the call for the restrictions did not work. As the graphs show, they continued after that call and until this moment. Sometimes, as they say, a little is enough. Earnings and growth still has room to spur the S&P 500 towards growth, according to some companies. When I say companies, I mean companies that are doing research and continuous research on the S&P 500. What has been fueling the market and will continue, in our opinion, to fuel the market is earnings. Yes, we're going to see some slowdown in earnings, but not to a point where it's going to cause the stocks to go into a negative territory. I think we'll continue to see some improvement, not just in the mid cap, but also in the large cap. The large cap have done well, and I think they will continue to do better. The risk aversion that a lot of investors have to the volatility created in primarily the small and the mid cap made a lot of the money run more towards the large cap over the last few years. There is the perceived safety of the larger companies, plus they are the ones who are paying most of the dividends. They are the ones who are capturing most of the tax benefits, and we're going to see the large cap continue to improve. What you have in front of you shows, for example, what the Russell and the S&P 500 have been doing on a quarter-by-quarter basis from the first quarter of 2018 and what we see as happening into the second quarter of this year. Obviously, we had some better periods in the past, but it does not mean that the large cap companies are going to stop growing anytime soon, particularly if you avoid some of what we call, and we'll see a little bit later, that the things to watch out for. Large cap is good, simply as I said, because earnings growth is going through a transition that favors shares of large U.S. companies. The growth rates for the S&P 500 and Russell 2000, as we've shown, after excluding unprofitable companies. In other words, we took out the companies that were not profitable and kept only the profitable ones. It shows a good that the large companies are good. There is more space. The pace for the S&P 500 was higher than that of the Russell 2000 in the fourth quarter, and after trailing in each of the first three quarters. The reversal is likely to last through mid-year based on analysis estimates. So we have at least another, say, 3 months period where we're going to see some of that trend continue, barring any unforeseen events or barring a situation where the Fed decides to raise rates much faster than anticipated, which most people anticipate that there will be no increases in the next quarter and probably delayed till later next year. And again, depending on whether the possibility of recession in 2020 is there or not. So if there is no possibility for recession, we may see them start raising interest rates. If not, we may see, if we see possibility of recession, we doubt that the Fed will raise much in terms of interest rates. However, there's not much room for the Fed to operate in terms of reducing rates. What they may do is go back to buying large quantities of bonds and expanding the balance sheet all over again that they've been trying to reduce for a while. The S&P capital spending sets a record, even though more money goes to repurchases, as we said earlier. That's why they were trying to kind of stop the stock buyback and channel the cash into other, into particularly investment and growth. And what you have in front of you is a little bit of history from 2007 till 2019. The blue represents the stock buyback. Obviously, that's a very big increase in 2018, and that's result of the tax break. The capital expenditures also did go up, but not by the same proportion. And dividends did go up, and those dividends are very sweet. That's the most steady part. The other two items could go up and down, but if you look at the dividends, they have almost a continuous steady increase, and that's a very positive thing for stocks and for investors like you and like us. The investors have been fed a misleading narrative that companies are foregoing investments in their business to buy back stock, according to Tobias Legwich of Citigroup. In reality, there is a substantial capital investment. Obviously, we could use more. Obviously, more is better for the economy and for the expansion of GDP, but we're not in bad shape in that respect. It was his conclusion that based on examining capital spending, dividends and repurchases on an annual basis by companies in the S&P 500 index. Will companies continue investing? Capital expenditures broke a record set back in 2014, according to Bloomberg. Even though more money went to repurchases last year than any time since 2007. So yes, a lot of money went into repurchases, and personally, I'm not for stock buybacks. They're okay to give you that shot of adrenaline temporarily, but on a long-term basis, obviously, investing is better. Now, if you are not investing at all, then I'll have a problem, but there is a good amount of the cash coming in being invested for growth into the future. Going forward, what should we do? First, adhere to proven systems and methods. Things that we have been using for 25 and 30 years that have been working very well, we're not going to shy away from them. That means fact-based research, investing wisely, making good selections, and looking for stocks that will pay us the dividends, looking for stocks that have a lot of free cash flow and solid markets for their products. So we see that reflected in technology again. We see that reflected in medical and medical equipment again. So we will keep going with some of those companies that we have already selected. There will be a few more selections as we're speaking. We're looking at evaluating some of these investments. On the fixed income side, we're not going further than 5 years. It's like the sweet spot right now where we're not getting any erosion of the principal, but we can still pull out about 3.5% in interest on these vehicles, which we can't even pull out of the 30-year bonds at this point in time. We did buy some exchange-traded funds that fall in that category, and John Velisca, who is our fixed income guru, just provided us with a list of very good individual bonds that will be adding to most of the accounts, if not all of the accounts, depending on the availability of the cash to meet the minimum investments for these vehicles. Obviously, dividends and dividend growth have always been a big staple for us for the last 30 years almost within Money Concepts, but even before joining Money Concepts, that was our staple for almost 40 years now. So that will continue because dividend stocks, for the most part, for us, are value oriented, and will do very well with that. Obviously, yes, free cash flow. That's almost like location for real estate. Companies with free cash flow will always do well. Adhering part of our system to the essential portfolio theory, which is diversifying to more than just fixed income and large cap. We'll have the mid cap, we'll have alternative investments, and we have done well with that type of style, maintaining the values of the portfolios. You can all you have to do is look back to times of crisis, and the Investors Advantage portfolios did very well in 2008 and 2002, and going back the same style to 87 and 86 for fixed income as well as equities. We always look for companies with low debt ratios. Those ratios can come back and haunt you if you don't pay attention to them. Companies like GE, besides making bad decisions on the financial side, a tremendous amount of debt that now they're liquidating assets to pay. We think GE will survive at a much smaller scale than what it is now, or maybe even as a split business into 2 or 3 companies. But until they get out of the debts that they're in, that's going to be an issue. We have a solid record for the last 3 decades at least. We're available to you as a team and as individuals to answer any question you may have for your individual investors, or if you have any need for proposal systems or for even group meetings, be it with existing client or potential clients, and we'll sponsor some of those meetings for you for dinners and all that stuff. So just let us know if you need us. And you can always look at the investorsvantageportfolios.com and see what and we're adding a few things to that in terms of articles, in terms of projections into the future, if you will. Or you can call the toll-free number 888-PLAN-111, or you can email flazreg@moneyconcepts.com or ngreen with an E at the end at moneyconcepts.com.